Eki, do you want to check on David? I don't see that he's back in the room as well.
Yes, what no.
Okay.
Thank you. Good morning, everyone. Good morning, everyone. Thank you for joining us today, um, and welcome to our webinar on building legacy and governance in a new tax era. So we'll just allow for an additional 5 minutes to allow for more participants to join in. Then we'll start at 11:06 a.m. Thank you very much. Good morning, everyone. Thank you for joining us. We'll be starting in the next 1 minute. Thank you. Good morning, everyone, and welcome to our webinar series on building legacy and governance in a new tax era. My name is Ekema Chukuneta, and I'll be your moderator for today. So it's wonderful to see so many of us joining us today. For those of us joining us for the first time, so I'll briefly introduce our company. Vetiva Trustees is a corporate trustee registered and regulated by the Securities and Exchange Commission. We are a wholly owned subsidiary of Vetiva Capital Management. Since inception, we've provided trust services to individuals and families. We've supported them in structuring, administering, and transferring wealth across generations. This experience informs how we'll approach today's discussions on building legacy and governance in a new tax era. So we thank you for joining us. Thank you for taking time to be a part of this conversation. Legacy planning and governance are becoming increasingly important, particularly as tax and regulatory environments evolve. And we have an exciting session lined up for you to explore these issues from both strategic and practical perspectives. So before we begin, just a few housekeeping points. We'll start with a poll, followed by our panel session, and then we'll end with a Q&A session. So if you have any questions as we begin, please feel free to drop the questions in the Q&A box, and they'll be answered at the end of the panel session. So a recording of the webinar will also be shared with attendees afterwards. Just like I mentioned earlier, any questions you have, comments, drop them in the Q&A box. If you have comments as well, you can also drop it in the chat box. So without further delay, I'll invite our Managing Director, Teresa Oji, to deliver the opening remarks. Teresa, please.
Thank you, Eki. Please confirm you can hear me. Okay, great. Good morning to everyone. It's a pleasure to welcome you to today's webinar on building legacy and governance in the new tax era. Now, whether you're a trustee or an executor, an advisor, a family office representative, or even a beneficiary, you agree with me that the responsibilities around estate planning and administration are becoming increasingly complex. That interaction between fiduciary duty, tax compliance, regulatory oversight, and family governance requires technical expertise, quite all right, but also sound judgment and strategic planning. Effective estate planning or governance goes far beyond asset distribution. It also covers safeguarding legacy, ensuring transparency, managing risks, and aligning decisions with both legal obligations as well as the vision of the estate planner. At the same time, we also know that evolving tax frameworks such as income tax, capital gains, estate and inheritance tax, even cross-border reporting, all require or in fact, they demand some careful restructuring and proactive compliance. And so in today's webinar, we want to explore strategies for trustees, executors, and other estate planning practitioners and participants who are navigating this increasing complex regulatory environment, as well as the governance frameworks that promote accountability and fiduciary best practice under the Nigerian Tax Act of 2025. So mainly our aim for the webinar is to more or less provide you with insights that are both technically sound and practically applicable that will help you strengthen oversight, reduce exposure, and preserve value for current and future beneficiaries. And so we are very delighted to be joined this morning by our speakers from KPMG, Shell's Professional Services and Tax Stream, who will be bringing their extensive experience in tax advisory and fiduciary services to bear on the webinar theme. And without further ado, I want to encourage everyone to participate actively, through your questions and comments as we look forward to an informative and engaging session. Thank you.
Thank you very much, Parisa. Okay, a great way to begin our panel session. But first, let's take a moment to hear from you, our participants. So I'll be launching a poll shortly, so you can share your thoughts with us. Okay, so the question is currently on your screen, and we have just one question, and with 5 options. So please, let's hear from you. Okay, so while the responses are coming in, let me just go ahead to introduce our distinguished panelists who will be guiding today's conversation. We are joined by 3 distinguished professionals bringing diverse perspectives to the conversation. Just like Teresa had mentioned earlier, we have David Apaflo, Kelechi Ibe, and Ijoma Uche. So I'll just briefly read out their profiles so we know who our panelists are. Mr. David Apaflo is a managing partner at Shell's Professional Services, and he's also the founder of Shell's Consulting, an SME-focused accounting and tax advisory firm. From working with governments to create autonomous internal revenue services to spearheading the restructuring and creation of departments therein, David has also helped states through tax audits, having participated in over 700 tax audits over the span of his career. In 2011, he founded Shell's Consulting, a company which offers a wide range of financial services and a core focus on tax consulting for governments, foundations, and other charitable organizations. David is a fellow of the Institute of Chartered Accountants of Nigeria, Chartered Institute of Taxation of Nigeria, and Institute of Management Consultants in Nigeria. He's also a member of the Business Recovery and Insolvency Practitioners of Nigeria. In 2013, he was nominated as one of Africa's under 35 entrepreneurs to watch out for. David shares his unique insight and opinions on his blog, www.davidapaflo.com, and is a columnist with Nigeria's premier online career portal, Jaros Hub, with a couple of his write-ups scoring over 13,000 views on Nigeria's most popular online forum, Nairaland. He speaks at various events, and he also spoke at a TEDx event on managing risk. He serves as the board secretary of Help Others Win Charity Foundation, an NGO dedicated towards improving the quality of education in Africa. So our other panelist, Kelechi Ibe, he's the co-founder and CEO of TaxStream, an AI-powered tax compliance solution built for African businesses. He's a corporate and tax lawyer with over 9 years of extensive experience spanning taxation, mergers and acquisition, finance, and general corporate advisory. He has a proven track record of providing strategic advice on high-profile, complex, local, and international transactions. His career trajectory includes roles as senior associate at Udo Udoma and Bello Osage, and in the deal advisory and M&A tax unit of KPMG in Nigeria. In recognition of his potential, he was seconded to Latham and Watkins in London in 2024 through the prestigious International Lawyers for Africa flagship secondment program. Kelechi actively shapes the legal landscape as the second vice chairman of the Taxation Committee of the Nigerian Bar Association's section on business law. He's an associate of the Chartered Institute of Taxation of Nigeria and is currently pursuing an advanced diploma in international tax certification at the Chartered Institute of Taxation, United Kingdom. His expertise is consistently recognized by leading industry bodies. He's ranked as a rising star in general corporate tax and transfer pricing by World Tax International Tax Review. His contributions were further celebrated when he received the Lawyer of the Year award at the 2022 CEOs Network Africa Awards and was nominated for the Future Awards Africa Prize for Lawyers, an accolade recognized globally, including by Forbes and the World Bank. Committed to social impact, he also co-founded Green Ridge Foundation, Nigeria's first technology-enabled corporate pro bono organization dedicated to providing free legal support to small businesses and founders. So lastly, for our panelists, we have Ijoma Uche. Ijoma is a senior management in a tax, regulatory, and people services division of KPMG Nigeria. She's a trained lawyer by profession, who has also qualified as a chartered accountant and supervises other team members in providing tax, legal, regulatory advisory services within KPMG Nigeria. She has over 11 years of working experience delivering value to clients in Nigeria and globally, and has had extensive experience in tax and regulatory matters, having advised several local and multinational organizations on international corporate taxation and business structure review, tax and regulatory compliance planning and advisory, cross-border investment structures for inbound capital investment and management structures, recapitalization and reorganizational schemes, corporate M&A, compliance health checks, and tax audits. Ijoma also possesses deep experience from having advised several local and multinational institutions on various assignments, covering several legal regulatory matters, contract standardization and structuring, reorganization and recapitalization, regulatory compliance checks and audits, voluntary winding up of companies, as well as startup advisory services. Thank you all to our panelists for being a part of this session. So we'll go ahead and display the poll results. So we will hear from you. So the poll results will be coming up shortly. Here we have the results now on your screen. So the question is, which of the following best describes your current legacy or estate planning position? So 10% indicated that they already have a trust. 7% said they have an estate planning structure in place, say for instance, a will, a life insurance, and the likes. 31% said they're considering setting up something. 50%, that's half of our attendees, have said they have not started planning yet. And 2% said, I don't intend to have an estate plan. I mean, for those that have not started planning yet, you know what they say, when you plan to fail, you fail to plan. And 2% said, I don't intend to have an estate plan. So thank you for everyone. Thank you to everyone who participated in the poll. So it's really interesting to see where everyone sits on the legacy planning spectrum. So we've observed that a majority, which is 31%, they have indicated that they are considering setting something up. So, so we hope that you're able to get useful insights as we move on to the panel session proper. So with that context in mind, now let's move to our panel session. To our participants, if you have any questions, please drop your questions in the Q&A box. If you have any comments, you can drop that in the chat box as well. Okay, so I would start with Ijoma for our panel session. So my first question to you is, with recent tax developments reshaping planning considerations from a perspective, what's the most significant shifts, if any, introduced by the Nigerian Tax Act 2025 that impacts trust and estate planning?
Okay, thank you very much, Eki. So thank you to everyone for joining the session this morning. And like Eki has said, we hope that at the end of the session, we would, be going back, thinking about the things that we should do next, right? So one of the things that I would say is most significant, right, is the fact that yes, we all know that there's now a consolidation of trusts and estates into a single unified national tax framework. And what do I mean by that? So we now see that the Act has explicitly said how trust to be treated and how the estate income and disposals will be treated as taxable, right? And of course, you're looking at this from the eye of what the Fitzgerald has said, of course, referring back to Section 16. So there's now the tightening of there's the residence, there's a source and the attribution rules, right? Where you're also looking at how chargeable gains or chargeable assets and gains would be, treated, especially with respect to trusts. So there's then the increased likelihood that if you have any income or you have any capital gains that is linked to Nigeria as a trust, whether it's at the trustee level or whether it's at the in the hands of the beneficiaries, right? There's going to be that eye that the tax authorities are going to be placing on everyone, trustee alike. And then there's also the one other major shift, right, is the raised compliance and reporting framework, for trustees as well. You're looking at, what are the what are the tax plannings that you had done before using a trust? How are you going to the law has now said, okay, all trustees are required, or estate administrators are required to disclose beneficial ownerships, right? How are you taking a look at that and putting together information that is required to provide the tax authority with that information? One other shift that I would like to talk about before, or maybe I'll just go right into the B part of the question, which speaks to what impact would this have on estates or trust and estate planning. You're looking at the fact that, like I just said, you need to make full disclosures of beneficiaries. So if you're in the room and you're a trustee, there's then that requirement for you to make those full disclosures. If you've had tax planning trust strategies that you have put together in the past using a trust, you would need to go back and take a look at that. Because sometimes in the past we had people using the trust structure, given that there was some sort of shielding from tax, but now it's no longer business as usual. The increased compliance and reporting obligations would now make sure that you're, taking a look at everything, obtaining legal advice from, well, whether legal or just advice generally from your advisors, and making sure that you have not made a plan on something that's really not work anymore.
Okay, thank you very much, Doma. That provides very useful context. I know you mentioned so full disclosures will be required from the end of the trustee. It will be good for us to also review previous tax plans based on the structuring for the trust or the estate plan. Yeah, I know you also mentioned increased compliance. So we'll just move from there to David. So on the basis of the shifts that Ijoma has mentioned, from a structural standpoint, are there any particular categories of trust that appear more exposed under the new framework? David, you're muted.
All right, good
Okay.
morning, everyone. Can you hear me now?
Yes, I can hear you.
Okay, so I think I'll just pick up the conversation on a light note from where the introduction stopped. See, one of the things that wasn't mentioned is that I'm a Vetiva alumni, and that's one of the heritage that I'm really proud of. But then picking up this conversation from, the results of the poll, it could mean that a lot of people might not be familiar with what trusts are and some of the terminology. So in a bid to ensure that some of the things we're saying are not going over people's heads, maybe we might take a step back to just try and define what a trust is. So I need to say that I'm not a lawyer, but I'll try my best approach to define it. So a trust is simply a legal arrangement where, a settlor is a person who has assets, right, and wants to create a trust. So the settlor transfers those assets to a trustee, like particular trustees, and says, okay, hold these assets on behalf of beneficiaries. Now, the settlor can also be a beneficiary. Other people can be beneficiaries. The children can be beneficiaries, the spouse, anybody you want to put in there, your parents, right? So in that agreement, right, we have a situation where even though the assets are not in the name of the settlor, that is you who is creating this trust, right, sort of have beneficial ownership to some extent because we get the proceeds or whatever distributions made from those trusts, right? And so the trust will not be registered with CAC as a separate legal entity. So imagine you are XYZ, you won't have XYZ Limited registered with CAC or in any place, but it's just that legal arrangement that subsists between you and the trustee. And so the trustee would hold the assets not for themselves or for their benefit, even though they're holding it in their own name. So if you had a building, for example, in the name of but for your benefit, right? And so that agreement, that trust agreement is what really controls that system. So with respect to the trusts that are exposed, with respect to the New Tax Act, one of the key ones are revocable trusts. The revocable trusts are trusts in which, even though you've created the trust, right, you can at any point in time cancel that trust, and then the assets can revert back to your, personal estate or your personal ownership. They also have irrevocable trust. Under irrevocable trust, you really can't cancel the trust arrangement, right? So in a situation where the settlor, that's the person who created the trust, or the person's spouse, can cancel that trust and retain control over the trust, right? In those instances, any income earned by the trust is basically seen as income earned by the settlor, right, for the purpose of taxes. Now, if as a settlor, you also borrow money from your trust, it could also be seen as if it is just you, because it is seen as if you just created a structure to evade taxes. So revocable trust, trust where the settlor has control. So if you have a general power of appointment, meaning you can decide who gets what from the particular trust, right? It could also be seen as the income just being your income. I just set up a false structure. We also have situations where there are offshore trusts, Nigerian residents. So the trust might not be domiciled in Nigeria, but if the recipients or the beneficiaries of those trusts are in Nigeria, there's now an exposure with respect to what the Nigerian Tax Act now provides. Then also there's the settlements for minors or married children who are beneficiaries of estates too. So incomes or distributions made to those minors or married children would also be seen as distributions received by the settlers of those trusts. Except it is not more than the national minimum wage. On the funny side is that cap used to be 500 naira before, so we can see it's gone several notches high. Even though for a lot of people who use trust, the incomes we're talking about are much more than a minimum wage. And the last category will be artificial setups. I sort of touched on it. In that instance, the law provides that the tax authorities can set aside any trust structure if they feel that the sole purpose of that trust structure was just to evade taxes. And so in their opinion, it is an artificial scheme that has just been created to hoodwink the tax authorities. The law gives them power to set aside those structures and look at the income, in that trust or coming from that trust as income of the settler. So those are the points, those are the categories of trust that are exposed under the new framework. Thank you.
Okay, thank you very much, David. So we received a comment that the volume is low, so I'd like to encourage our panelists to increase. Okay, thank you. Okay, so building on that foundation from David, so Kelechi, could you walk us through the provisions of the Act, mostly that directly affects the taxation of trusts or estates, and how they differ from the previous regime?
Okay, thank you. To be honest, there aren't that many changes in the new law that has affected the way trusts, settlements, family income, and the likes are taxed. Ijoma has spoken to a few of those that seem different, but when you compare the provisions of the second schedule to the Personal Income Tax Act and the fifth schedule of the Nigeria Tax Act, the provisions are substantially very similar. I guess the only few differences, which again are not substantial, are like the new act now defines what family income is. And I know that used to be that was one of the thorny issue when the reforms were happening. A lot of people said, oh, you now want to tax family income. But then that provision had always been there. Families were always subject to tax. It's the only difference is family income has now been specifically defined to include the income of families from all sources. So, and I think that clarity. I don't know that it was very necessary because again, there was always going to be taxes for family income, and the law even specified how family income should be taxed. I mean, the previous law, the Personal Income Tax Act. So I think that's apart from what IJ mentioned, there's no real difference if I have to put it that way. But it's good for people to know generally how the tax, works. And when you look at a trust arrangement or a settlement, there are, like David had spoken to, that several parties involved. There's the settlor, there's the beneficiary, there's the trustee. The trustee could be an individual or a corporate trustee like Vetiva. And so you need to understand the various tax treatments that different parties in that arrangement have. And that arrangement has remained the same from the old law and the new law. The settlor is still liable to tax on any income he receives from the trust if it's a revocable trust, or if the settlor, he or she, still exercises substantial control over the trust arrangement. So if you set up a trust, which ideally should be independent of you, because if you look at the Nigeria Tax Act, the definition of person includes a trust or any arrangement. So effectively, it treats the trust arrangement as separate from the settlor and every other person benefiting from the trust. So if as a settlor, you set up a trust, which is supposed to be independent of you, run by a trustee, but you still benefit substantially, you still have control over a lot of the activities of that trust. The trustees don't have discretion to decide how to run the trust. Any income you earn from that the trust rather earns, the trust income will still be attributed to you as the settlor's income. That has always been the case. That has just been made clearer now. And I think another interesting provision, I don't know if it was in the old law, but that I have noticed is if you have a young child, I think it's in the old law, an unmarried young child uh, who is a beneficiary under the trust, the income that that child draws from that trust arrangement is attributed again to you as the settlor. And I think it's always been the provision. So when you look at the settlor's income, that's there. You now deal with the trustee's income as a trustee, your fees under the arrangements, how you pay your tax. It's the same provision. The trustee has his own tax. Then as a beneficiary, any income you draw from the trust, in terms of, I guess, benefits will be taxed as well. But I think the more important thing to mention is not really the way these people are taxed, it is what is now taxable and as what, because under the Nigeria Tax Act, we know that there's been a uniformity or a convergence of capital gains and income into income tax. So while there used to be structuring arrangements to tax certain income as capital gains at a lower tax rate of 10%, that structuring arrangement is now impacted by the new regime because there is no separate regime for capital gains anymore. Every gain you make from any disposal of an asset is now taxed as income tax. So it means if your trust has shares, has real estate, has life insurance and all of that, and there are any disposals of those assets, the tax treatment would follow the income tax treatment in the hands of the settlor, in the hands of the beneficiary, and any remainder of the income that has not been distributed to the settlor and the beneficiary will be taxed in the hands of the trustee. And that sort of suggests that the tax rate is going to increase because you're moving from a 10% tax rate for gains to a regime where you're paying for personal income tax at a marginal rate of 25%. Depending on how your deductibles are added, you could have an effective tax rate of around 16%. So that's there's actually an increase in the tax that families, trustees, settlers and beneficiaries will pay under the new regime.
Okay, so in addition to the increase that you mentioned, Kelechi, so this is just a question. Does it not suggest double taxation in any way?
Yeah, so no. So I think that one of the interesting things about the framework for taxing families, trust, settlement, and all of those is that there is a clear, almost like a waterfall arrangement on how the income is taxed. So you do not um, find a situation where the same income is taxed at different levels by, so the settler, so it's like an apportionment. That's how the law puts it. So income is apportioned, and that's each person pays their tax in their own hands. So the settler pays his tax, the individual beneficiaries pay their taxes, and the trustees pay their tax on their fees. So there's a clear provision on how you calculate the tax. So from when there is like an income for the trust, the deductibles that are allowed, the cost of maintaining the estate, the cost of, preserving title, a lot of things are deducted. And it's only the net amount, I guess, that's now distributed to the settlor and the beneficiaries, or the beneficiaries rather. The settlor can be a beneficiary under the trust. So I'll just use the word beneficiary. So the net amount which is now distributed to the beneficiaries are now taxed in the hands of the um, individual beneficiaries. But you could have a situation where maybe because of some cross-border arrangements, an asset is located outside of Nigeria, because the provision of the law is if you bring in proceeds, you're a settlor or a beneficiary in Nigeria, and you benefit from an asset outside of Nigeria, and you bring in the proceeds into Nigeria, you are liable to pay tax on that income as long as it's been brought into Nigeria for assets offshore. So in those kind of situations, that asset may have been subject to the income or the gain may be subject to tax in the other jurisdiction, and again subject to tax in Nigeria if you're bringing it in. But I think the important thing is to look at what kind of income you're dealing with. So if it is like dividends, interests, rents, royalties, that the trust is earning and the money is brought into Nigeria through like a domiciliary account, then there's no tax. But if it's like regular income that's not within any of these categories, then there's a risk of double taxation. But I think that under the provisions of the NTA Section 120, there is a provision to claim a foreign tax credit. If you suffer tax outside of Nigeria, you could claim a foreign tax credit as an individual for many taxes you suffered outside of Nigeria. So that's to a large extent would help manage the double tax risks. That's in addition to if you're dealing with a double tax treaty jurisdiction, which is also why you need consultants to structure your arrangement, because dealing with countries that have a double tax treaty with Nigeria can help mitigate double tax risks for a business. So yeah.
Okay. Thank you very much, Kelechi. I know that our participants are finding these discussions very insightful and something to reflect on. I would just like to mention this again. If you have any questions as we go along, please put them in the Q&A box and we will respond to them. So Ijama, returning to you. So given the changes that you had mentioned earlier, do you expect increased regulatory scrutiny of corporate trustees and other estate planning practitioners? And what should they prioritize internally to remain well positioned?
Okay. So I would say yes, first of all, and thank you, Aki, for that question. I would say yes, in the first instance, because yes, corporate trustees are expected or can expect to increase to an increased regulatory scrutiny and higher audit risk. And why would I say so? So you see that, for example, the Nigerian Tax Administration Act has granted the tax authorities greater powers, whether it's to audit, to investigate, or to demand any form of documentation from trustees, right? And of course, this is inclusive of corporate trustees. So yes, there's going to be scrutiny because of that. And then there's also the earlier requirement we had spoken about, I think myself and David had spoken about earlier, with respect to the mandatory disclosures. So yes, the new law requires that there's a detailed disclosure of beneficial ownership, distributions, foreign assets, all the entire gamut, right? And so because those requirements exist, it then makes it easier for the tax authority to say, hey, this is a trust I think I want to, this is an estate that I think I want to review, I think I want to audit. And of course, working with the corporate trustees. So that's one. And then the final reason I would say yes to that is, I mean, the whole um, the whole reason for this tax reform act and where we've come to at this point is we're looking to, as a country, come to a point.
Hi, Ijoma. I don't know if you can hear me. Hello, Ijoma. Okay. I'm believing it's network issues. Okay, so please just give us a few minutes to reach out to Ijoma to confirm what the issue is. Okay, so we'll continue while we reach out to Ijoma to continue with her response. So Kelechi, I'd like to pick up on what you had mentioned earlier. So maybe just to provide further clarity. So has the Act clarified who ultimately bears the tax burden? I know you had touched on it earlier, the trustee, the beneficiary, or the trust, or are there any gray areas that we should watch out for? Then how basically estate practitioners and trustees, how they should be able to navigate all this?
Yes, thank you, Eki. The law indeed clarifies who should pay, taxes. So the trust in itself doesn't have a tax obligation. The trustee bears the tax responsibility of the trust. So there's a provision in the fifth schedule that says when the income of the trust has been apportioned to the various, I guess, participants within the arrangement, the trustee, the remainder of that income will be apportioned to the trustee. So in essence, the trustee would pay the tax for the trust, assuming that the entirety of the trust income is not distributed to the beneficiaries under the arrangement, under the trust arrangement, under the settlement. So again, that's not a new provision, but it's just good to mention it. It has always been the case. The other thing to mention, though, is there is a provision also that deals with trustees' responsibility. There's an umbrella provision that says that everything that has to do with the trust would be attributable, or the trustee will be answerable rather for everything that relates to the trust. So that word answerable also applies to even tax as well. So if you're a trustee managing a trust, you're responsible for the correct treatment of the tax issues that are prevalent within the trust arrangement. So that's a huge responsibility for even the trustees themselves. So it doesn't even it's not just limited to your income as a trustee. It also, because you have general oversight and management of the trust, that includes responsibility over tax. And I see the NRS, and not just the NRS, even the state tax authorities, because trustees, well, it depends on if you're a corporate entity or you are a business name or an unincorporated entity, but I see the relevant tax authorities rather relying heavily on that, blanket umbrella provision to hold trustees responsible for the tax affairs of any such arrangement. And there is also a critical provision in the Nigeria Tax Administration Act that imposes an obligation on the trustee, the settlor, the beneficiaries to disclose any changes that have been made to the trust arrangement. Mostly there are changes to the beneficiaries and any details of the trust. There have to be disclosures to the tax authority. And that's also another responsibility that trustees have to bear. But aside from these ones that I have mentioned, the law is pretty clear who pays what tax, what the settlor pays, what the beneficiary pays, and all that. So there's really not much confusion anymore.
Okay. Thank you very much, Kelechi. Insightful response. So Ijoma will be joining us shortly. She has connectivity issues, but she'll join us shortly. So David, I know Ijoma had mentioned when she was talking about the shift earlier. So she had talked about the fact that it would be good for persons that have a trust to revisit the structure that they have. So based on what has been mentioned earlier in our discussion so far, do high net worth individuals with existing trust structures need to revisit those structures now with the objectives of restructuring, and what should they be looking out for?
Yeah, so I mean, of course, with all the changes that we've seen this Nigerian Tax Act bring, it's definitely important that these structures be reviewed and revisited. A key part is the trust deed, for example, really, really, really needs to be scrutinized. And what we should be looking out for are things like what sort of power and influence does the settlor have over the trust? We should also be looking at, the intra-trust transactions.
Sorry, David.
How is the...
Sorry
Yes.
for cutting.
Can you hear me?
Increase. Okay, better now.
Okay, so we should also be looking at, the intra-trust transactions. How are they priced? Are they priced at arm's length? Because there's also that arm's length provision. We should also be looking at the real substance of the trust because, the law provides and gives power to the NRS or to any tax authority to set aside the trust arrangement they feel is a fictitious arrangement. So definitely, there is need for all families and, ultra high net worth individuals, and even emerging people to just look at, the trust deeds and try and see in which ways there's, so more or less like an impact analysis. Okay, what ways, based on the unique terms and provisions, conditions that I've set in this trust deed, how exactly, would there be impact? So they then start to see the impact because the changes that would happen for each trust would be dependent on, the unique provisions that are in the different trust deeds. But one that, can be really looked at for almost all trusts will be around the powers that the settlor still has with respect to, the trust. So that's one very important area that I think that, trusts need to look at in, managing the complexities that come with the new tax act and whatever it has provided to us.
Okay, thank you very much for that insightful response.
You're welcome.
I believe our attendees they are taking note of these useful insights. So back to you, Kelechi. So this will be talking about family offices now. So how are family offices affected by these developments? Are we seeing any shifts in governance or reporting expectations? How can they be better positioned to meet these expectations?
Yeah, thank you. So family offices are effectively, I guess, managers. So I had cost to do some work, setting up a family office sometime in my previous place of work, and it was a bit, defining what a family office really is, so because a lot of it depends on the structure you choose to take. For some people, they set up a company, right? Like an asset holding company that pretty much holds most of the assets of the patriarch of the family, I guess, or the matriarch, whoever is setting up the family office. So it's the arrangement could be as simple as having a company that has interests in various entities, and then there's management at that holding company level. That still qualifies as a family office. For some people, it's just maybe having a multi-family office structure where they ascribe management of their family affairs to an independent entity that just oversees, and also that entity also manages several other families. So it's like a multi-family office. So in reality, what a family office is would depend on the structure you set up, and the tax treatment would also follow the structure you decided to take. So if you say, let's say you set up a company, and that company is just holds most of the assets of the the interest, has title or holds the interest for the patriarch or matriarch. So let's say the patriarch or matriarch have transferred ownership from themselves directly into that family, that holding company structure, and then it's being managed at that level. The tax arrangements, the tax implication will just follow the typical taxation of a corporate entity, of a company. So in that instance, what would happen is, any income that entity derives from all of the assets, the investments it holds, will be, taxed in the hands of that company, unless it is like a franked investment income, which, where there is a redistributed income, let's say it's dividends. So instead of holding my shares directly in the stock market, I set up an entity to buy the shares, and that entity, receives the dividend and redistributes it to me. And so at that tax treatment, that income is only taxed once, and that's the withholding tax. But for every other kind of income that you earn, it's not franked investment income. Or unless if it's like, okay, for instance, bonds. So if you invest in bonds and short-term securities, like I think treasury bills, the tax you pay, that withholding tax is the final tax. But that is an income specific tax. But generally speaking, if you set up a structure like a corporate entity to hold your asset and manage your affairs, that entity would pay tax on its own income because that entity has to earn income one way or the other. And then any redistribution from that entity to you as a shareholder in that structure would also follow the usual tax treatment. So, but if you also set up a family office, like the example that I gave, where it's a multi-family office, there's an independent entity running it, but you're still holding on to your assets in your capacity, but someone else is just managing the affairs, deciding what instrument you invest in, deciding, where you're managing your family's affairs, essentially. Maybe where your kids go to school, paying your kids' school fees, where you go to for holidays. There's an office managing all of that, and they're getting fees. That family office would pay tax on its own fees for that arrangement. That would be different from if you had your own entity running your affairs and not, part of like a multi-family office. So the tax arrangement really follows the structure you chose. And the reporting, there are no specific reporting obligations for family office per se. It's just every other obligation that a company has. So for instance, if you are a company and you have ultimate beneficial owners and you hold an asset, that you have to disclose, who your ultimate shareholders are as an entity, not because you're a family office, but just because you are an entity and you have, disclosure obligations under the persons with significant control regime. So that obligation exists, not because you're a family office. Because as of today, there's no framework for governing family offices or structures around family offices, unless the family office is maybe a qualified investor in the capital markets, then there's some level of structure. But if you're not set up as the kind of family office that is qualified as an investor under the capital markets, there is really no regulatory framework that governs you. So no reporting obligations. You're just bound by the regular obligations that any company has, which is to report income to the tax authorities, report shareholding arrangements to the CAC, and the likes.
Okay, thank you very much, Kelechi, for the insightful response. So we have one of our attendees. We have your hand up, Osita Matthews. A member of the team would respond to you shortly in the chat box. Then after the webinar, the panel session, if you have additional questions, we'll reach out to you. Thank you. Okay, so back to Ijoma. Ijoma, please confirm you're with us.
Yes, I can hear you.
Okay.
Apologies. Network was being very funny, but I am back now.
Okay, thank you. I know you were talking about how trustees and estate practitioners should be able to position themselves in this new tax era. So I don't know if you want to continue.
Yeah. Well, I mean, the last thing I was speaking to was the fact that, yes, there's a focus on transparency and making sure that, anti-avoidance provisions are not mismanaged, so to say. So in terms of what the corporate trustees should bear in mind, I think it's basically what we've been saying since the webinar started, and the fact that there has to be robust record keeping, there has to be compliance with registration requirements, and for those of us who are also not trustees, where you are looking to a trustee to help you with managing your affairs, just to make sure that you regularly consult, because really it's not supposed to be business as usual. So regularly consult, just to make sure that you're not making mistakes, or you're not relying on something that you knew in the past or you thought you knew, because like we would say in local parlance, we say ignorance of the law is no excuse. So you can't tell the FIRs when they've come knocking that, oh, I didn't know this existed, just seek cancel as may be required. So that's how I was going to end that.
Okay, thank you very much. Just as Ijoma said, you have to engage the right practitioners, and Vetiva Trustees is here to hold your hand throughout the activity. Okay, so if you have, just keep the questions coming. We have some questions here. We'll take them at the end of the panel session. If you have additional questions or comments, please keep them coming. Thank you very much. So Ijoma, we're still together. So in your opinion, I know our attendees would like to know, do these developments make trust more or less attractive as legacy planning tools for families?
So I would say it's dependent to you as an individual and what your risk appetite is, right? Some people will take a look at all of the the things that you're not required to do when you own a trust. So there's the fact that some things have been tightened, the increased compliance and reporting, the fact that it's clear now, right, that if there's a distribution from a trust or an estate to beneficiaries, that income or that distribution is then taxed in the hands of the recipients, right? So the previous loophole that we've had has then been closed. So then the anti-avoidance provisions we spoke about, the fact that the NRS has now, or even for individuals, the state revenue services, that they've now been given more powers to enforce, to investigate, and all of that. And then the big one, which is the higher administrative burden. When you look at all of that, some people may think, with all of these records I have to keep, with all of the reporting that I have to make, the fact that I have to now go and register and get the tax authorities to know who my ultimate beneficiary or owner is in that trust, right? You may think that all of that is a lot of burden, but guess what? Once you're speaking to the right people, you get the right guidance. It may not be as bad as you think it is. Yes, you have people to guide, put your hand, put you through what you're supposed to do. So all those increased administrative burdens and the legal costs that may be required may not necessarily be so much to you as much as you think anymore. So I would say yes, because of all the things that you're required to do. But in terms of whether it's still efficient, I don't think it has lost its taste as being an efficient tax planning tool. So like I would say, speak to your advisors as well, and like Eki said, Vetiva is also here to support you as much as you need.
Yes, we are. Yes. Thank you very much, Ijoma. So we're still with you. What implications do the changes have for onshore trust involving Nigerian resident beneficiaries versus non-resident citizens, and vice versa?
Okay. I think the one thing or maybe two things, right, that I would like to point out in terms of offshore trusts. The law has then made it clear, right, for offshore trusts, what you're looking at is are the beneficiaries resident in Nigeria, right? So if you have trustees and beneficiaries that are in Nigeria, of course, that's the definition of residence, or the residency definition automatically brings, whether the trust is offshore or not, it automatically brings, that income that you make from the trust into the tax net, right? And so that's one thing in putting together whatever your structure is. You need to make sure that you're following the rules. I mean, the trustees would technically determine what the residency status, what their residency status is, right? So what they would need to do if it's an offshore trust, you're making sure that you're reviewing the trust deeds, um, and at the same time you're then trying to determine, if it's an offshore trust, whether any income, whether the Nigerian tax would apply to such offshore trust income. Is just remember that it's only based on the fact that you are then bringing that income to Nigeria, or that trust is deriving income from Nigeria. When I say deriving income from Nigeria, is that trust deriving income from an asset that is currently here in Nigeria? So, because even if you have an offshore trust, I think it was Casey who was speaking to that. If you have an offshore trust and you have assets that are, here in Nigeria linked to that trust, you're yes, you're a trust that is outside of Nigeria, but at the same time, your income, part of your income is something that you have derived from Nigeria. So if that happens, of course, that's attributable to Nigeria, and of course taxes will be paid. So you just need to determine two things, whether, if you want to still keep your offshore trust, are you taking in some measures to say, okay, well, all of the assets that are in Nigeria wouldn't be covered under that trust, or I do a separate trust under it, it's just for the Nigerian assets? Because whatever you bring in here, I think that's the bottom line. Whatever comes into Nigeria would, of course, be taxed, whether it's an offshore trust or not.
Okay, thank you very much. We have quite a number of matriarchs and patriarchs on the call, so they're taking note of all of these useful points. So I'm back to you, David. So looking ahead, what practical steps would you recommend that trustees or families take over the next 6 to 12 months to remain compliant?
Okay, so talking about compliance levels, the first thing will be registration requirements. So just as Kelechi had alluded to when he was speaking earlier, the Nigerian Tax Act sees the trust as a taxable person. And the law also provides for all taxable persons to then register and get a tax ID. So it means that trustees or the settlers must register their trust with with the tax authorities. Now, in registering, of course, part of the information that will need to be provided is information on the beneficial ownership. Who is the settler, who are the beneficiaries. So we just need to bear in mind that that registration requirement is now a requirement of the Nigerian Tax Act. So even though it might not have a life of its own, it's seen as a taxable person in the eyes of the Nigerian Tax Act. The second thing will be to conduct a substance audit. So you basically want to really review and see whether there are any traces of just an arbitrary arrangement that can lead to the tax authority setting aside your trust arrangement. So you want to be able to review those structures and see if there's even any reportable arrangement that you might need to say, okay, disclose to the tax authorities, because as you might be aware, there's a requirement to even disclose your tax planning strategies to the tax authorities. Say, okay, these are the strategies that I'm using to manage my taxes. So if there's need to report any of those structures, we need to review the different trust structures and make those reporting where necessary. There's also the need to formalize the book of accounts. We can't overflow this point. Taxation is all about figures, all about numbers. So if the numbers are not organized, they were not even in any position to determine the computed incomes or the tax payable. So it's always going to be a mess. So we really need to organize and formalize our books of accounts to ensure that we're able to clearly delineate the incomes attribute them to different sources, and so that's easy to categorize these incomes for tax purposes. There's also something around reviewing residency status too. In recent time, we've been having a lot of inquiries about people considering moving to some tax havens like Dubai. So there might be situations in which your residency status might exempt you from having your global income subjected to tax in Nigeria. It might not shield you from tax from Nigerian sourced income. So meaning, even if you are not a resident of Nigeria, the income you earn from Nigeria will still be taxable in Nigeria. But because the new tax laws now provide for your global income to be taxable in Nigeria, the residency status might now limit the income taxable to just income that you earn from Nigeria. There's also the part around, preparing for the powers of substitution. Knowing that according to the laws, right, the government has the power to appoint anybody who is in custody of property, assets, or cash on your behalf to pay any tax that is outstanding. But of course, before those powers are exercised, you must have gotten to a point where all legal options have been exhausted. They've sent you demand notices. The demand notices are final and conclusive. You have not objected to it, and then a final tax has been assessed. And the final point I'll say is please ensure that you engage the services of a competent tax consultant. Thank you.
Thank you very much. So we have now come to the end of the panel session. Thank you to all our panelists for sharing thoughtful and practical insights today. I'm very sure that our attendees, from the questions that we have lined up, they've listened and also they've taken notes of everything that we've said today. So I'll just quickly go to the Q&A box to take the questions that we have here. So we have a question here from Fubara Samuel. Taking the issue of double taxation forward, if most of the trust investment is in money market or treasury bills, which 10% is deducted? Seems to me it would be double taxation setting up a trust. Kelechi, I don't know if you want to take this question.
Yeah, so this question tends to be dealing specifically with certain kinds of income. To start with, money markets, under the Nigeria Tax Act, collective investment schemes, income from collective investment schemes are exempt from tax. So if you earn money from your money market fund, your mutual funds, from my reading of the Nigeria Tax Act, income from a collective investment scheme is exempt from tax. So that also means that that income is not taxable, even for the trusts, right? And that, of course, the beneficiaries under that trust will not pay tax on those kinds of income. I think the government is trying to encourage more investment in collective investment schemes. That's one. So there's no issue of double taxation when you're dealing with that category of income. For treasury bills, short-term securities and long-term securities, the Nigeria Tax Administration Act actually treats income tax on those categories of income as franked investment income. Pretty much the withholding tax, once deducted by the the trustees managing the arrangement, the bond arrangement, because usually when you have like treasury bills, there's usually like the banks who are the intermediaries between the government, the CBN, and the note holders. And then for regular bond issuances, you'd have like a trustee who's handling the funds for that arrangement. For those kinds of arrangement, once the withholding tax has been deducted, because your treasury bills, you get the money, you get your discount income is what suffers withholding tax. And once that withholding tax has been deducted, that's the final tax under the Nigeria Tax Administration Act. That wasn't even the case before, but that's now before. Some categories of that income they were completely exempt up until 2022. Between I think 2011 and 2022, that income wasn't taxed at all. Treasury bills, bonds, any coupon you earned from those categories of income were not taxable. But after the sunset period, between 2022 and 2025, they were now taxable. But I think now the provision is that the withholding tax would apply, but that will be the final tax, which means after you've gotten the income, you don't have to disclose it again under the trust arrangement and pay tax again in the hands of the respective beneficiaries. So that again deals with the double tax problems that the entities would have had. But just to clarify, when you pay withholding tax, it is not withholding tax is an advance payment of income tax. So you can't call it double taxation, even if the law didn't treat the income as franked or like the withholding tax as the final tax. If that provision was not there and the banks deduct withholding tax from treasury bills and you receive the income as a beneficiary under the trust, you still have to pay your tax in full on that income, but then the withholding tax you had suffered would be given to you as a credit to offset the tax you have to pay. So in essence, it's not double tax. It's so that you had paid part of the tax in advance, and that's how withholding tax works. So that doesn't create a double tax scenario at all. Yeah.
Okay, thank you, Kelechi. So we have another question here from an anonymous attendee. Can trust be a vehicle to avoid, not necessarily evade tax in the new tax law? And is the proceeds from the trust tax in the hands of the beneficiary, even if there is capital gains depending on the assets? David, please, I don't know if you will take this.
Okay, yes, so I was smiling because I think when I initially saw the question, it was evasion, and I think it really that should be modified to avoid that. So I need to clarify that when it comes to taxation, avoidance is legal, but evasion is illegal. Now, with respect to trust, I think one of the biggest, benefits of a trust, right, is for transferring wealth to the next generation, right? So, in the situation where you have assets that you want to transfer to the next generation, if you were to use some other structures apart from a trust, you might have some estate tax, to pay at the probate and the likes. And so the trust still, retains that value, because in that instance, right, the tax is charged on the asset base, not necessarily the income. And as you know, the income might be a fraction of the value of the asset. So the trust still has, very, very significant advantages. Now, also with respect to the programming of and distribution to beneficiaries, right? The trust in certain instances can have a way in which the distributions go to, beneficiaries maybe in lower tax bands. There's a way in which the distributions to the beneficiaries can be managed such that the overall tax burden is not so high. So you can distribute income to those in lower tax bands, and find a way to smoothen that tax expense. So yes, there are definitely systems and structures that can be put in place utilizing trusts to minimize your overall tax burden. But I would like to say again, tax evasion is illegal, but tax avoidance is very, very, very legal. And I even encourage everybody here to pursue strategies that would help them avoid tax. Thank you.
Thank you, David. So we have another question here. Do family offices have to be set up as trusts? If not, what's the best structure to set up a family office to reduce tax implication? Ijoma, this question is for you.
Okay, thank you very much. So it doesn't have to be set up as a trust, and I would say that with a caveat, because every family, the peculiarity of your situation determines what you decide to do, right? There are people that, there are things that they think about. They're not just thinking about the beneficiaries, they're also thinking about the residency and the citizenship of the beneficiaries. So you're just not going to say, oh, because the trust structure worked for Mr. A, a trust structure has to work for me. So you need to you need to seek specific advice, just to make sure that you're not taking a one hat fits all, one cap fits all approach. And so that said, there are different ways that you want to set up a family office, and so you, depending on what your peculiarities are, really looking at where your beneficiaries are resident and what is the issue. So for some of us here, we have some of our patriarchs and matriarchs that are possibly Nigerians, and then they have their children who are American citizens. So you're thinking about a whole lot of things, and so you can't just take the answer straight up and say yes, that's what it is, and then you run with it. You need to seek advice that is specific to your situation.
Okay, thank you, Ijoma. So we have so for the attendees asking if the recording will be sent, yes, we will send the recordings to you after the webinar. Then we also have some questions around setting up a trust and the cost. So we are going to drop our email address and phone number. You can reach out to us at any time. And as you've heard from the panelists and also myself, we are here to hold your hand through the entire process. You can also send us an email or you can call us at any point. So that's to questions around setting up trust, even drafting your will as well. Any estate plan, depending on your objective at the end of the day. So you can easily reach out to us. So let me check. Okay. So yes, email address and phone number is up now. You can have that. Okay. Okay, so thank you all for the questions. If you have additional questions after this session, you can send it to us via email, and we will reach out to the panelists and send the appropriate responses to you. You can also call us and we'll provide you with the appropriate response. Okay, so as we wrap up, so I'd just like to hear from our panelists one more time. So just for your final takeaway. So in one sentence, what practical piece of advice would you offer to individuals or families navigating legacy planning in this new tax era? I mean, we saw from the poll that quite about 31% said that they'd like to set up or have an estate plan. So just your final advice. So we'll just start with you, Ijoma.
Okay, so first, for trustees and and families that are navigating the Nigerian Tax Act, one thing I would say as the most practical takeaway is prioritize compliance, prioritize documentation, conduct a thorough review of your trust deeds, and just make sure that you're on the right track.
Thank you very much. I'm David.
Okay, so for me, I'd say first of all, trust still remain good structures to use in estate and wealth planning. So please don't run away from trust, embrace it. Speak to qualified trustees like Vetiva, and then with respect to taxation, I'll say let's all continue to seek more knowledge. So it's good for tax advisors to give you knowledge, but you as the settlor, beneficiary, or even a trustee, it's also good to get more and more information on these things, because the tax landscape is changing. Also, it's important for us to note that we're still expecting a lot of guidance from the Nigerian Revenue Service and other tax authorities with respect to how they intend to implement certain sections of the law. And some of those interpretations might further guide practical implementations of this act. So that's all I have to say in closing. Thank you very much, and thank you for the opportunity to be here.
Thank you very much, David. So Kelechi.
Thank you. I think just at the back of what David has said, we're expecting guidance from the relevant tax authorities, but that also means that as taxpayers, citizens, people looking to do set up trust or any kind of planning, you need the knowledge, right? Knowledge is power. Don't be worried or scared because there's this frenzy that the tax laws have come to take everybody's money. And a lot of people have been misinformed. And a lot of the things people are scared of are actually not true, are not correct. It's just that most people are misinformed. So I'd encourage people to join sessions like what Vetiva has put together and any other one that you see reputable, tax experts speaking on. And I think Vetiva would be a bit more of these kinds of things. I'd encourage you to always attend and get real not advice, because advice has to be tailored, but just get guidance generally, because if you're relying on the things you're hearing from people who have zero experience doing tax work, you get worried and misled. So always speak to consultants, but importantly, also join sessions like this where you would learn more around what you need to do. So thank you and grateful for the opportunity, Vetiva.
Thank you, Kelechi. So thank you to all our panelists for your thoughtful closing insights. And to our attendees, thank you for honoring our invitation. So if you have any questions that maybe we've not answered that we missed, please feel free to send us an email at trustees@vetiva.com. If you're interested in having an estate plan, setting up a trust, drafting your will, you just want to understand trust basically, reach out to us at trustees@vetiva.com. So it's trustees@vetiva.com, and we'll be here to guide you. So we've come to the end of the webinar for today. So I'd like to call on our Managing Director, Teresa, to give us the vote of thanks. Thank you.
Good afternoon, everyone. Thank you again for joining us today. From all the discussions that we've had today, you would agree with me that we've had a lot to unpack with regards to the tax obligations on trustees, settlors, beneficiaries, executors. But also one of the key things that I took away was that heightened oversight from the regulators and so forth does not necessarily affect your goal of transferring your wealth seamlessly to the next generation. And so trusts are still relevant. There are relevant vehicles for you to do that. We want to thank all our panelists, Mr. David Apaflo, Mr. Jamal Uche, Mr. Kelechi Ibe, for joining us and giving us their valuable insights, perspectives, and so forth with regards to how we can go ahead and manage our estates. We also thank our moderator, Ekemado Chukuneta, for a time well spent. And most especially, we thank you, our participants who have joined and also engaged actively, asked your questions and so forth. We truly appreciate all of you. We look forward to further engagements. You can reach out to us on the contact details that we have already put in the chat. If you want more information, just as Kelechi said, advice, you need advice that is tailored, to your own specific situation. And Vetiva is here to help you with that. Once again, thank you all for joining the webinar. We pray that you have a good afternoon and also a good weekend. Thank you.
Thank you, everyone.
Thank you. Bye, everyone.
Guys, have it.
And goodbye.